There are opportunities to develop an industrial and a post-industrial base in a carbon-efficient way. The challenge is getting the funds into the hands of people that can really make the most difference.
We have to go at a pace that achieves real change. I would plead for a convergence of the standards, simplicity of the standards, focus on what really matters.
We think that business has a huge role to play in providing a lot of these solutions in partnership with the public sector to have these projects out there and mitigate climate change.
Karen, those are two issues weighing on the market right now, and I want to run you through two of the big stories at the moment. First, that liquidation of Three Arrows Capital, a source telling me yesterday that the company is in the liquidation process. Teneo has been brought on board to deal with the process. They're in the early stages right now, but a source tells me that at the moment Teneo is trying to realize what assets Three Arrows Capital or 3AC has, and in the next couple of days we'll set up a website to allow creditors to make claims from Three Arrows Capital. Now, it's worth recapping how 3AC got there. You mentioned the price of cryptos plunging and that really having an impact on many of those firms. This was a company, a hedge fund founded in 2012 by Carl Davis and Ju Su, very bullish on the space. Even Mr. Ju said that he expects that Bitcoin could hit $2.5 million per coin one day. He has since admitted that his super cycle view of Bitcoin has been regrettably wrong, but that bullishness really led to highly leveraged trading strategy at 3AC, which proved effectively unsustainable with the price crash. And that crash led to a series of events at 3AC. Firstly, it reportedly failed to meet a margin call from lender BlockFi. It had exposure to the now collapsed Terra USD stablecoin, and on Monday the company defaulted on a more than $660 million loan from Voyager Digital. That is how 3AC became one of the latest victims of the crypto winter. Now,
if you can't come to us, we'll come to you. Need an instant check of your personal watch lists? You've got it, just the way you want it. What's the latest?
There are
And welcome back to the CNBC Crypto Night in America. We are continuing to follow breaking news. Voyager Digital announcing today it's the latest crypto firm to suspend withdrawals, deposits, and trading. Voyager's exposure to the embattled crypto hedge fund Three Arrows Capital includes 15,250 Bitcoin and $350 million worth of USDC. And here to shed some light on what forced the liquidation of Three Arrows means for creditors like Voyager is Mackenzie Sagalos. Mackenzie, how have Three Arrows issues impacted the broader crypto community?
So the crypto market is falling apart right now, Frank, and the latest casualty is Voyager Digital. Voyager's big announcement today comes just a few days after the once very prominent crypto hedge fund Three Arrows Capital defaulted on a loan to Voyager worth more than $670 million. Now, at the time, Voyager said, hey, no problem. Alameda Ventures has already committed to $500 million in financing. We're all good, but clearly that wasn't enough to keep things running as usual. And so the fallout from the forced liquidation of Three Arrows Capital, or 3AC as it's also called, has begun. Remember, just a few months ago, 3AC had $10 billion in assets under management. Now it's failing to meet margin calls, liquidating its holdings by court order after failing to repay its creditors. I mean, it's even being reprimanded by Singapore's central bank, which is where the fund is based, for providing false information and exceeding the maximum amount of money that it was allowed to manage. This is why there are such big concerns about a knock-on effect across the crypto market more broadly, exactly like what we saw today.
So, Mac, I've been following some of your reporting. Three Arrows, one of the biggest crypto hedge funds, widely respected. What went wrong here? Was it just the price drop, or did they also make some mistakes?
Right. So 3AC has been around for a decade, and it really was this darling of the bull market in 2021. But what we've seen in the last few months is this sort of perfect storm of black swan events. The price of cryptocurrencies has plummeted, and that affected any firms with exposure to crypto, but especially 3AC, which had this highly leveraged trading strategy that was unsustainable as the price of cryptocurrencies dropped. And then in May, you had the implosion of a very popular US dollar peg stablecoin project called UST, Three Arrows Capital had exposure to that project, reportedly lost more than $200 million. So it's just been this string of bad luck for the fund.
A lot to unpack there. Mackenzie Sagalos, we appreciate it.
Arjun, we're well aware of pain across the sector given the crash we've seen in cryptos, but just give us a sense, is this a wave of consolidation, a flush out? What's happening now in the sector?
Yeah, a bit of both, actually, Karen. I'll just start with this Three Arrows Capital story, because this is one of the most prominent hedge funds in the crypto space. It's nearly a decade old. It was started by Carl Davies and Ju Su. And what's interesting is if you listen to their comments, they're extremely bullish, and that gives you a sense of the way that they went about their business. Mr. Ju last year said that he predicts one day Bitcoin will be worth 2.5 million per coin. This year, he said he was regrettably wrong on his super cycle thesis, but it underscores Three Arrow Capital's extreme bullishness towards the market. It's highly leveraged bets that it took on the markets, and we're now starting to see that unravel as we've come to see this market crash in the crypto space. They failed to meet a number of margin calls. BlockFi, a lending firm in the crypto space, reportedly liquidated some positions from Three Arrows Capital. The company also had exposure to the collapsed Terra USD algorithmic stablecoin, as well as the subsequent crash of Luna as well. And so it suffered heavy losses from that. Now you're seeing it unable to meet that repayment of about $670 million to Voyager Capital, as Voyager Digital even as well. The risk is really for the market is how much the contagion might spread. We've seen some of the impact as well already. But what else is Three Arrows Capital is exposed to? Will it have to dump a bunch of holdings? And there are any more large market players that could be exposed to Three Arrows Capital? Those are the worries and questions at the moment. I think that's why you're seeing that pressure on Bitcoin today.
Arjun, we sit around the desk and as we look at changes in industries, we ask ourselves a question. Is it cyclical or is it structural? And as we look at what's going on with this whole industry, there are obviously lots of businesses that are now struggling, and maybe they didn't have the right idea to start off with. Robinhood, we know, was a darling of retail investors for a while, who are relatively new to the whole theme of investing. But it did very well off the back of that spurt as people got bored during lockdown and punted around their COVID money. As we go forward, what do you think these changes indicate as to the nature of what the crypto industry is going to look like, or indeed what the new retail investing audience is going to look like? Is this a significant structural shift, or is this ultimately just the collateral damage from an interest rate change?
Yeah, I think that there's a couple things at play here. Certainly, there are structural issues in the market, and we've seen that play out with some of these firms that are offering, 18% yields, i.e. Celsius, and the issues they've had there. And we've seen when it comes to market crashes, they happen to find themselves in liquidity issues, solvency issues, credit crunches as well. And so there are structural issues with the way a lot of these businesses are marketing and the setup. But I think also when you look at, and I think you're alluding to there, of course, this story about Sam Bankman-Fried and FTX looking to take over Robinhood. I think with FTX specifically, they have a lot of ambitions beyond crypto. They started off with crypto, and I was speaking to the head of FTX US at Davos a few weeks ago, and they were saying this is a great time for acquisitions, where they have already begun jumping into stock trading. And the way he explained it is they see that as a broader part of an offering to the retail consumer. And I think that when you look at the retail consumer, as you mentioned, Robinhood did very well during the pandemic, but also it does speak to a more structural way of consumers wanting to trade in a much easier fashion, as they're used to using social media and apps and others. Trading platforms are going their way of the app as well. And so there could be a big market there. And I think that's what FTX is sensing here. If they combine sort of their strength in crypto along with stocks, that could be a big play for them.
Arjun, since it's your birthday, I'm going to ask you another question and make you work a little bit harder. Binance and the regulatory approval in France in the last few weeks. I wonder why Binance seemed so happy when I caught up with them in Paris and why they seem so comfortable there. But is there a split now between how central banks feel about crypto and also how some countries want to have this open arms approach to crypto just in case it really is the next big thing in financial innovation?
Yeah, well, the central banks, of course, they're very much interested in what they do with central bank digital currencies. And we heard that from the head of Asia Pacific at the BIS just in the last couple of days, talking about the importance of central bank digital currencies, how stable coins, particularly algorithmic ones, aren't necessarily going to be the future. So the central banks are on that path in terms of trying to digitize fiat currency, I suppose. When it comes to countries, yeah, we've seen that in Europe in particular, France looking to sort of open the doors here to crypto. We've seen it here in the UK, of course, with the announcement of, the UK government trying to regulate stable coins and others. So I think there will be a race, particularly amongst European countries now, in terms of how to go about opening and welcoming this industry. But I don't think it's going to be as open arms as perhaps we've seen in other jurisdictions like the UAE or Singapore, where they are moving a lot faster on the regulatory front, but a lot faster also in trying to bring companies in as well.
Terrific, Arjun. Many happy returns of the day, and we'll see you on later programming.
I think the Fed's forecasts are still remarkably optimistic.
Arjun, we're well aware of pain across the sector given the crash we've seen in cryptos, but just give us a sense, is this a wave of consolidation, a flush out? What's happening now in the sector?
Yeah, a bit of both, actually, Karen. I'll just start with this Three Arrows Capital story, because this is one of the most prominent hedge funds in the crypto space. It's
everyone loves spreadsheets. Actually, they don't. But check this out. Okay, Monday.com, get started, import from
Hey there, Eamon. We've got more damage in the crypto lending space. Voyager saying that it's temporarily suspending trading, deposits, withdrawals, and all loyalty rewards. That was effective at 2 p.m. Eastern. That release, though, just coming out, and CEO Stephen Ehrlich saying, quote, "This was a tremendously difficult decision, but we believe it is the right one given current market conditions." He says the decision today gives them additional time to keep exploring strategic alternatives with various interested parties while preserving the value of the Voyager platform. This is an investing app. It's also a lending company. It comes after major crypto hedge fund Three Arrows Capital defaulted on a loan to Voyager. The company is saying on Monday that hedge fund failed to pay a $350 million loan in the U.S. dollar-pegged stablecoin USDC. They also had a major Bitcoin loan that the hedge fund defaulted on. That was worth more than $300 million. So we're seeing a lot of margin calls and defaults lately in the crypto space. And remember, that company had also gotten a $500 million loan from Sam Bankman-Fried's Alameda Research. So, guys, this is the latest fallout we've seen in the crypto space. Back to you.
So suspending trading, deposits, withdrawals, I mean, that's a lot, right? You wonder what happens to the customers here.
We've seen this also. There's a major crypto company called Celsius that did the same thing 2 weeks ago and hasn't really had an update since. So we've seen companies seemingly facing liquidity issues, not being able to honor some of those withdrawals and deposits, and without a lot of other options, saying, hey, we need to close the doors for now. And it seems like a lot of these companies are scrambling on the back end to find other options and really stay afloat at this point.
Wow,
but
Kelly, imagine if a bank did that.
Oh, my gosh. But are the underlying funds safe, Kate?
Good question. So a lot of the underlying funds have been used for a lot of these other crypto companies to do lending. So they've gotten these high yield accounts going and to customers saying, if you deposit your crypto here, you'll get a return on that. But on the back end, we're going to go lend it out to hedge funds. Unclear here. The company doesn't comment on that specifically. They say that's in the works. They're figuring it out, but no details on that, Kelly.
The crypto markets, they've lost about $1 trillion in just the past few months as enthusiasm has quickly faded for this sector. The conversation has really shifted from how to navigate the volatility to whether you should be touching cryptocurrency at all. Let's bring in our expert panel. Crypto expert, Skybridge Capital founder Anthony Scaramucci, executive director of Duke's Law Global Financial Markets Center, Lee Reiners, and co-founder and partner of JST Capital, Scott Freeman. Gentlemen, thank you all for being here.
Thanks for having me.
So, Lee, I got to start with you. Last time we were here, you coined the phrase crypto yonkers. It was you kind of making fun of the idea of crypto Bahamas. And metaphorically, it seems like we're in a very different place from crypto Bahamas. Have we reached that point of crypto yonkers, as you mentioned last time? And how do you see crypto investing going from here?
I think we've reached that point, Frank. So start to book your hotel. I mean, listen, as Kate just said, crypto's problem, there's many right now, is that it's finding a hard time attracting new buyers. And in essence, the entire space operates like a giant Ponzi scheme where it takes new money to pay out old money. And unfortunately, it's always the people who can least afford it who are left holding the bag in the end. And that's exactly what you're seeing right now, just absolutely heartbreaking stories of, everyday Americans who have lost, in essence, their life savings. This was entirely inevitable, though. I've been saying this for a long time, that crypto has no inherent value. And so when you look at, where's the bottom, obviously crypto has only existed in a zero interest rate monetary policy environment. So as the Fed continues to raise interest rates, I expect crypto will continue to go down. In long term, Frank, in order for this asset to have any value whatsoever, it has to provide genuine economic utility. It can't just be a means to speculation. And we're 13 years into this experiment, and I have yet to see that so-called killer use case when it comes to crypto and blockchain, and you have to wonder, will we ever see it?
All right, just for our viewers who may be just joining right now, Crypto Night in America right now, we're following two big breaking stories. One, FTX looking to acquire BlockFi. The second one, Voyager Digital, having some liquidity issues, not allowing any trading or withdrawals. Anthony, I'm going to come over to you. These liquidity issues, what do they say about the broader cryptocurrency market and the investability of cryptocurrencies?
Well, Frank, unfortunately, there are no new mistakes. And so we saw this in 1998 with the long-term capital management crisis. We saw it in 2008. And listen, there's a lot of people that were over-levered in the system. They were overzealous. There was double collateralization going on. It was almost like Bernie Madoff got married to long-term capital management, and they created Celsius. And so some of this stuff is terrible, frankly. But I do think that Lee's ultimately going to be wrong, because the use cases are proliferating, and there's billions of dollars that is moving into the space. And of course, we haven't gotten to Sam Bankman-Fried, who's been willing to backstop the space and put up capital. So lots of smart money there. It's not crypto yonkers. In fact, crypto Bahamas. I just got back from the Baha Mar Hotel. We'll be doing that April 17th to April 20th. And hopefully Lee can come down and make the bear case for us again. But I think he's going to be wrong long term. This is just part and parcel of a long-term trend and cycle. And of course, we have the halving coming in February, March of 2024.
Scott, I'm going to come over to you. I mean, again, not a great sign for Voyager Digital to say no trading, no withdrawals, and no deposits.
Yeah, it's been a brutal market for crypto for the last 3 to 6 months, right? And I agree with a lot of what Anthony said, that we've seen a lot of these problems before in traditional markets. So we believe there are some great use cases out there. We think the market will continue to grow. Crypto is a volatile asset. It's always been a volatile asset. It will always be a volatile asset. And I think people need to be very careful when they get into crypto. You need to expect aggressive ups and aggressive downs and be able to navigate it. But a lot of the problems we're seeing today are problems that are just typical of growing ecosystems, but of finance in general. The problems with Celsius, the problems with Voyager, the problems with 3AC, the problems with Babel. There's a whole list of them about liquidity events or challenges managing risk. These were risk management challenges. These weren't crypto challenges. It was affected the crypto ecosystem, but these were all challenges of people mismanaging risk. And unfortunately, retail folks are going to get hurt.
So, Anthony, back over to you. You mentioned Sam Bankman-Fried. What do you make of the fact that he's the person, as you mentioned, that seems to be backstopping the entire cryptocurrency industry, and it doesn't seem to be anybody else racing out to buy BlockFi? He seems to be the one that has the interest and believes that it is a valuable asset.
Well, first of all, a big shout out to the BlockFi people who focused on depositors first. They took a deal from Sam. It may not have protected the equity there, but it's certainly protecting the depositors. I think in Sam's case, he's looking for customer acquisition, and I think he sees this as a broad opportunity to get those customers through BlockFi. And BlockFi, by and large, other than the fact that they were over-leveraged, they ran a pretty decent company. Remember, somebody mentioned Bear Stearns. Bear Stearns had the liquidity. They just had a liquidity mismatch in the short term. Same with Lehman Brothers. And so somebody like Sam stepping in here I think is providing the context for a bottom. And just a quick correction, when I said Celsius, I meant 3 arrows as it related to the potential fraud.
We start off with the most important chart in the market, according to one of our traders. T-bills versus the semi-spill. Over the last 5 days, bond prices have rallied, with the yields in the 10-year dropping below 2.8% today for the first time in over a month. Meanwhile, the SMH semiconductor ETF has plunged down 9% just this week, far outpacing the losses that we saw in the broader markets. So, Rosso, we point to the SMH is very important all the time, and the declines in yields, I mean, they were just breathtaking this week.
Yes, they were. And if I look at yields on a basis going back to November 2018 to the highs of June, basically 2022, the 50% retracement for yields is 2%. The reason why I bring that up is that those two dates, the 2018 date and the June 2022 dates, that looks like to me a double top for yields. So I do think we're going to get a respite as we've seen wheat prices come in, gasoline prices come in, commodity prices come in on a monthly basis, not as a whole. So I don't think we're out of the woods there yet, but I think we're going to give enough to Jay Powell to maybe take his foot off the gas, and you're going to see yields come in from here.
Tim, you're actually the one who brought us this important chart of the week. So what does this signify to you?
Well, I feel like it's a broken record in terms of the importance of the semiconductors because of their cyclicality, because of their epicenter dynamic in terms of supply chain and also inventory dynamics, over-ordering, under-ordering, et cetera. But look at the underperformance of the SMH, or the SOX Index Semiconductor ETF. 4.5%, almost 5% to the S&P today. So stocks were up. You had a sense that there was actually a decent start to the quarter today, but it really wasn't. And if I look at semiconductors, the underperformance to the S&P in the last, call it 20 days, is about 13%. Again, to an S&P that's been down aggressively. This is how much the semiconductors have underperformed, and it's in stark contrast to the rally in bonds. And obviously, they're the same story. It really is facing the recessionary risks head on. What we've seen in the last 3 days, as referenced with the 10-year, going from 350, we're at 280 on the lows today. Obviously, bonds didn't finish at those low on yields, and they actually rallied back a bit in terms of yields move higher, bonds sold off. But it was really an ugly, ugly day, and we pointed out this week, and I think we're going to continue to point out, it may be okay to see those interest rate sensitive stocks rally, especially mega cap tech stocks on a day like today, and they will carry the market. But what I saw today was pretty ugly, and I think the move in the semiconductors is downright scary, because that talks about the real epicenter of the economy.
I mean, within the S&P 500, the moves were defensive. Within this rally, we saw the biggest gains in utilities, for instance. We saw a rally in the bond market still, Courtney. So what do you make of all this, especially in light of semiconductors signaling? The latest data point is from Micron. They just talked to investors in early June, and they said that things are worse today than they were at the start of the quarter. Then they talked to us yesterday, effectively, with their guidance, and said things are even worse than that.
Yeah, and I think you're seeing this across multiple platforms, right? You're seeing consumer spending is coming down. You're seeing the manufacturing index is coming down. And Tim brings up a really good point here, that if we follow his logic, that some of these semiconductors are leading to the idea that the economy is slowing down here. It's one of those ideas that really good news for the economy has been bad news for the stock markets, but maybe now the opposite, where some bad news that the economy is actually starting to slow down is what people want to see here, and that the Fed is going to start to hopefully ease on their rate hikes, which could inevitably be a good thing for the market. So I think this actually could be one of those good news, bad news scenarios, which is inevitably maybe good for the markets.
Pete, do we get a respite? Do we get a respite in terms of selling, particularly in tech names, because of this pullback in yields?
Well, I tell you what, the very first thing I look at each and every day, Mel, is the yields. And I look at the 10-year and the 2-year, and if I see them, especially right now, obviously, as we've dropped underneath 3, and I want to see what kind of an acceleration we have on that drop, and that obviously transfers over to the markets pretty quickly. As a matter of fact, in the last 3 hours of the day, that's when we had all of the big gains that we were looking at it today, as a matter of fact. You look over at the Dow up 300 points in the last 3 hours. You look over at 160 points on the NASDAQ. So that really did flip things around very, very rapidly. Real quick on the semiconductors, this has been going on for a month. This is not just the 1 week thing. The 1 week has been awful, but they've really been struggling for a while now. And then obviously with the Micron news today and some of that, what was forecast, there's a lot of nervousness out there. I think Tim's 100% right on this one, and I continue to look at that. We have seen put buying across the board, not just in the individual names, but on top of the individual names in the SMH as well. And they're not just going short term, Mel. A lot of them are, but most of them have actually been moving out in time, all the way out as far as September and October. So it's pretty interesting to see what we are seeing in the options market and how that's playing out right now in the markets themselves. But you know, I still do need to point out 7 or 8 of the biggest sectors actually finished up 1% or more today. So it was a pretty broad-based move to the upside. I realize tech really did struggle, but everything else just seemed to be off to the races.
Yeah, Steve, you wanted in?
Yeah, so to Pete's point, so I've been negative on semiconductors for a while now, but the problem is only Micron is below the February 2020 level. So if I'll give you a point of reference. If NVIDIA has to get down to that 2020 level, it's going to have to be cut in half. That is a big move. All right, we're talking about 50% move down. Now the SMH, the 2 top names, TSM, Taiwan Semiconductor, and NVIDIA account for about 20% of that index. So TSM is not as bad, though, but it still would have to be chopped up maybe 30% to get down to that February 2020 level. This is a matter of wanting to see the pull forward of these semiconductor names. So there's a lot of room to the downside, and we're going to have to dip down. We didn't even talk about the ISM levels here, or we're looking at June 2020 levels for ISM and May 2020 levels for ISM new orders. The S&P was at, during those levels, if we push the S&P back, you're looking at between 2,800 and 3,100 in the S&P. So overall, we've got to chop a lot of wood before we're calling bottoms in the overall market.
I have a question about the baseline, though. Why does the baseline have to be pre-pandemic? Like, why does it have to be February 2020? Why that baseline, Tim?
Because we're...
Grasso, why that baseline?
Yeah, I'll give you just a small snippet. We were in an environment at that point where we were not in a rising rate environment. So you have to flip the script. We had a huge tailwind to the overall market, a huge pull forward for semiconductors, hardware, everything across the board. But you have to go back because we're in a rising rate environment and everything is calculated on discounted cash flow. That's why technology stocks will run when rates are low and not when they're in a rising rate environment.
Well, then that's depressing, because that'd be a lot of wood to chop below on the S&P 500, Tim.
Yeah, I mean, Paul Bunyan here, and I think part of that Feb 2020 dynamic is okay. That was we talk about companies on a 2 or a 3 year stack. So we get back to February of 2019, and you're looking at companies within the context of normalized earnings to that point. What's relevant is I would make an argument, we could argue, that we are in a period of secular stagnation. We were still coming off that period where the Fed seemingly overstepped its bounds, tried to raise rates in the fourth quarter of 2018, December of 2018. We all knew where we were on Christmas Eve with the stock market down 20% that month. But the rally from, I don't know, September, October, November of 2019 into that Feb 2020 level was also pretty extraordinary. I would make an argument, and this is where you get into Paul Bunyan territory, is that Feb 2020 is not even the right level to look at. That's an environment where there's zero inflation and where rates are at zero. Should equities be valued in the same context as that moment in time? And I'm not sure. Yeah.
So then should that baseline actually be lower?
Yes.
Yes. Okay, so it's even more depressing.
More chopping.
The Treasury market seeing a wild ending to the first half. Let's bring in on-air editor Rick Santelli for some context. Rick, I saw a stat that the 10-year bond specifically